And all the big problems truly are with the big banks, by the way. It's not little ABC credit union in small backwaters town in a Midwestern state that's going to bring down the system.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 12th through February 19th, 2024, while supplies last. First, we feature backdated 1-ounce Silver Philharmonics at $3.15 over spot with a minimum order of 50. We also have pre-1933 gold $10 and $20 Liberties at $99 over melt and $145 over melt, respectively. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the market sniper. Francis, thank you so much for joining us today.
Delighted to be with you, Elijah.
I wanted to first discuss the banking system and also move into the economy and how it's impacting gold right now, because we're seeing quite a pullback actually in the gold market. First, with the banking system, Powell did a 60-minute interview last week where he said that some of the smaller banks certainly will close, but the situation in the big banks is manageable. Your perspective on his comments and what this means for the banking system in general, where we are.
Yes, fascinating that he says that. The Fed works for the big banks. Essentially, they are the shareholders in the Federal Reserve. And I find it very ironic that in actual fact he's conceding, because obviously we had the beginning of last year and then the beginning of this year, smaller bank wobbles. It's almost as if he is conceding the smaller banks and prepared to admit to vulnerabilities there, but that everything is awesome on the big banks. And this sounds like a herding exercise for the mass of American citizens from the smaller banks. It's almost as if they're saying, well, we'll take a view on who we save if you're small. But when it comes to big, you're too big to fail, and you've got a guarantee. So it seems like a two-tier society for the banks. And thereby the net expectant reaction you would get out of people naturally that are with small credit unions or minor banks is that they would prefer to move their banking to one of the larger insider oligopoly of banks. And it seems that Powell is playing that game. So you're probably going to see banking consolidation as a result of people's net responses, because they're saying they're going to let little banks hit the wall. But the big banks know. And all the big problems truly are with the big banks, by the way. It's not little ABC credit union in small backwaters town in a Midwestern state that's going to bring down the system or has built a derivatives position. So it's very typical type statement, and it's very agency related. I don't think he's lending the protections he should to the smaller rats and mice of the banking system, and I actually think he's actively herding people towards the too big to fail banks. That's my take on that. You also mentioned the gold pullback as part of that, as your part one to that question, and the CPI numbers. Something just how that came to be, because we actually again so we trade small opportunities as well as invest. So we are in net longs in gold and silver. And sometimes if I say something like, well, I took a short in gold or silver for a thing, it upsets people because they kind of think, you're the guy that's bringing the market down or whatever. It's more about the mood music and how they've framed gold right now, Elijah. They've framed gold as, listen, we're going to have a major pivot. There's going to be lots of interest rate cuts. Gold go up. So gold is now a proxy for interest rate cuts. It goes up on interest rate cuts. And if those cuts are going to become less large and less of them, then suddenly it's as if rates go up, meant to be bad for gold because gold doesn't pay any yield, as Warren Buffett won't stop reminding you. And they're keeping you in the return on capital thinking, the framing. It's the legacy framing that it's always been, the search for yield. And we've regularly stated on this pod with you that it's no longer about the search for yield. We have a major epidemic debt based crisis, and it's preservation of capital, and that refers to the return of capital rather than the return on capital that people should be focused on account of the debt situation. But they're going to maintain this narrative, and what actually happened on the CPI numbers, and it starts further than that actually. So the CPI was kind of Valentine's Day. But actually on the 2nd of February, and this is why we have our live trading event always on the first Friday of the month, they give you a signal on the narrative they're likely to be pushing. You often get pivots and inflection points in market directions as a result of the biggest data, that most critical data, which is the non-farm payrolls number that comes out on the first Friday of the month, which, as I've mentioned, was 2nd of February. And the numbers shocked me there because I don't think things are that awesome, unfortunately. However, that we got a very much an everything is awesome set of numbers. The expectation was absolutely smashed by almost 2x in terms of job creations. I'll remind you that there's a statistical anomaly known as the birth-death model that just randomly adds jobs in on the basis that there's some things that aren't counted, and therefore it has a fudge number that has a lot of statistics behind it, a bit more than I've cared to explain, but generally can flatter the number, and that most non-farms that are being restated very regularly are being restated to the downside subsequently now that nobody is concentrating on that number. But anyway, let's just go with the, lies, damn lies, and statistics that they gave us on the 2nd. The very strong numbers, the increase on relative earnings beating the expectation. So all three were expectation beats to the upside and positivity. And that tends to set a bit of a trend on direction on the 2nd of Feb. So we were getting another batch of big numbers recently on the CPI, and we said the Fed needs actually to not have to do too many rate cuts. Again, we go back to that classic explanation of bond. It's, the seesaw that I've reminded everybody about, that if the rates go down, the valuations go up, rates being my hand and the elbow having to raise. So you're on a fulcrum here, and they don't have the buyers. They don't have the demand for the huge proliferation of new debt that is being created, all the short-term debt that they issued more recently that needs rolling, and everything else. So there is an absolute glut. There's no scarcity at all for T-bills. And how do you do rate cuts? Well, you actually need the capital value to be bought up. And where's all the money that's going to come from that's going to be doing that? Well, it's not China and Russia anymore. It's not many international nations. After you took 300 billion of Russia's treasury notes because they're bad, how many other nations will think, that's not such an agnostic financial system anymore, the SWIFT system with the treasuries and all of these things? It seems quite politicized. I'm not sure we can see these as risk-free assets anymore. So all these actions are actually creating a lot of pressure on the bond market, and they don't want to do that amount of cuts. One way they can get away with doing less cuts than the bankers expect and the institutions are demanding because of the softness of the economy in our view is that they show the economy to appear strong. And that's what you got on non-farm payrolls. And therefore, when CPI was coming, for the consistency of that narrative, we felt that the CPI would probably be in tune with the non-farm payrolls data on the 2nd of February. So when the 14th came in, we biased too high on the CPI, which will once again say, strong economy, there's still inflation out there, can't cut the rates near as much. And the actual first rate cut, which was at around 69, basically 7 out of 10 odds for being a cut, fell more than 50% to literally mid-30s, so about a third. So that just goes to show how they poured cold water on this thing that everyone's been waiting for and discussing. It's not discussed by us very much, the pivot and the massive return all the way down, until you get what we would call a major event demand destruction. We don't see much joy for rate cuts at all. There may be a few, there may be minor, and there'll be a short while, but until we get event-driven news, and you'll know it when it happens, like March 2020th, we don't see there being the bond demand for there to be the rate cuts. Everybody is in the fallacy, Elijah, that the Fed sets the rates. They do in the short term, but if the market isn't buying the bonds, then the rates change. As I mentioned before, in the Soros bond, British pound crisis, the Bank of England changed the rates twice in a day, and that wasn't them changing their mind halfway after tea. That was the market saying, we ain't buying your debt. It's going down, 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 otherwise rates going up. And they had to match the market's rates going up. They became the trailer, not the truck. Very, very quickly when the world chose to disagree with them. So this is kind of the setup we are. But for now, we're getting these stats managed strong. And I think that takes some of the pressure off the Fed on delivering cuts and is managing down the expectation on rate cuts. And of course, with the framing for gold being as it's been, that, gold go up if the yields are going to get cut, gold go down if rates are going to go up. We, of course, had a spill on that data on the gold side. So that's my two comments on the two parts in your question.
So it seems like right now, gold has kind of priced in a lot of rate cuts for 2024, but obviously that expectation has been, it doesn't look like there are going to be as many rate cuts as people expected. So where do you think gold will fall from here? What will be its base?
So when it comes to a question like how far do we go and what was the trade and all of that, that's invariably a technical question, Elijah. So if you can enable screen share on that, I'll take you to the charts because it's on the charts that we'll get the answer. So it's a very tempestuous period with the 2K. We've on the monthly over here, we haven't really held above it properly without dipping back below. We're in and around the 2003 at the moment. And you can see we had the wick and then a very strong rejection. And when I drop down to the lower timeframes, you'll see this. And your question, to answer that, because it's important that we answer your question straight out the box, is how much more might we go? And I think that's going to be a little bit data dependent. This big rejection, and this is a wick, and it's a very rare wick. You're on a 4-hour chart, and that was 2,150 high. And inside the same chart, you on the same candle, a 4-hour candle, you're at about 2,075, 2,071. So in a single 4-hour candle, you've literally had yourself nigh on an $80 move. And if you take the whole day, you're talking about one of the most blow-offy candle wick events we've had in a long time. And that's been the reaction, I think, to the 2,000 mark, which is very, very psychological, which if I turn the lines that I typically have already on, you'll see right away. So this is that. There it is there, the blue line being the technical 2K level, which is so significant. And our trade that we've put on was very much that if it's not an up move, what is actually happening is that we've got a chart up here that wants to break down through the 2K. And this is a bit of a slap in the face event. It was a bit of a rejection of building a base above the 2000 mark, and that we've subsequently since then had a little bit of a winding up period for a downside technical break. You can see that move up, that move down. This was very grindy going up here. You can see this price behavior, very small spinning tops, taking a long time to get small beer ground, and then a very harsh sell-off. So we look at the swings in the momentums when you're getting these impulses, where that's impulse one. And what we find is that the up leg was far less determined than the rebound here. You can see the slope and the gradients. And the sell-off was almost bidless. So what probably happened is after we had this big run where gold was making new highs and you actually traded the 2,150, you then got the strong rejection. The minute we traded below the 2K mark, a lot of bulls might have run in. But we're tired and we're thinning out bulls, and they chased the market back up, but they were then exhausted. And the subsequent chasing on the second impulse has been far more labored and has shown that there was a real bid absence here. So what we're actually getting is a downside break. And you can see the data, the CPI data here. This was us calling it, this was 2 days before the data came out, and referencing a couple of our gold friends. and saying, we think this is going to break down, and you got that breakdown move. Now, you typically do get a return move after a breakout, but that target that I've drawn on there, that's going to take you down to the lower 19s. If you're patient, I'll redraw it in for you. That's the risk reward. But it's a bearish structure. So it looks like we might have to dip below, if this is accurate, by the way, and it can, of course, be incorrect, but it looks like the setting of, and I put it both technically and fundamentally, it looks like the setting is there's a stream of statistics that is very much in the everything is awesome camp. Growth and inflation, all stronger than everyone expects, or certainly beating the expectations that were set. If that is to be the theme on the fundamental biases, and with the framing of how it is framed for gold, in other words, interest rate cuts less than expected, that is a bit like raising rates, with the framing that gold goes down on a raise rate environment because it's not paying a yield, and that old legacy yield being the determinant of value, then you're going to get sell-offs on gold. And for the moment, that argument is winning out. There aren't enough people saying there's way too much debt. You're going to have a runaway system. They can't cut, and you're going to have interest rate spikes. If you start to get people that with our kind of narrative making it through, you're going to find yourself getting a much stronger gold market. But it's almost like they're gaslighting us for now. And everything is coming out so groovy in terms of everything. And of course, the stock market's made recent highs, et cetera, et cetera. So, and again, I highlight the stock market is not the economy. But when you're in an inflationary environment, especially a stagflationary environment, your stock market can run because the dollar basis is being devalued. But that doesn't mean retail, everyday man in the street is having a great time. And I think eventually those realities come crushing home. Because with bad consumers, even Amazon's going to start having bad earnings because people aren't buying things on the same scale, and it'll work into cars like Tesla, Netflix, and some of the fancy stocks. And maybe that's we'll start seeing a little bit more of that. So gold is a breakdown, we think, to the low 1900s. We say every moment's a good accumulate. This is a good time to be on a monthly dollar cost averaging, where you're just net accumulating. But I'm not expecting any fireworks right now out of precious metals across the board. The one slightly more positive element that I do have to say, because I'm hardly being a bundle of joy at the moment for precious metals people. I mean, because I've looked at platinum pre-chatting to you, I've looked at palladium. Palladium has kind of stopped going down. It's made its big low on a target we had finally. But silver and the gold-silver ratio has actually been holding up a little better. So we'll just pivot quickly to the silver because it'll be your next question. And the thing I'll be highlighting is this key $22 mark. It's been a soft floor a number of times in the last 2 years. You can see it, each of these little red circles. Yes, we got smashed through it when we had a really tough ride. Then it was a soft resistance for a while. And then you got up and above. And then it's been a soft floor since, but for a very short spill. And we bounced off that. And that's a little bit of a falling wedge. So silver seems to be holding up a little better than gold. You'll notice that's a green candle for the 3-day chart, which is okay. And typically these technical patterns, you can come out a little bit to the upside. So there's kind of a conflict there. And in terms of it, so I don't think it'll be chronic in gold. It doesn't have to go to the lower 1900s, but the expectation was we had a setup, we had a pattern, and it did break very much as we thought. And the good news, as I was saying, the one element of good news is that gold-silver ratio, even though gold's not performing, we prefer to see it on gold going up, a weakening gold-silver ratio. But what we are seeing is there does seem to be a sort of fundamental, you can't go much lower for the silver price here, because you can see this rejection and this coming off. Again, we've spoken of this range for a long time that we've been appearing with you, Elijah. I mean, all of 2023 and, well into 2024, we've been range bound in this area. And each time it's come down, we said, could this be the moment? Could this be the moment? And there's been a lot of crying wolf. And occasionally we've been threatened on the top side as well, where, the metals haven't looked well. You've got these top side interaction, then down, and then we've come back again. So we are still bouncing in this range. in that channel that I've drawn in blue, and it's for quite an extended period. And I would like to see this go down and reach this level and then battle to go too much higher again and then eventually break that level. And that will be a bit of a champagne cork popping moment for us, because at that point, I think we'll be in a situation where gold will probably be firmer, will have shaken its head, taken a little bit of a dip for a while, and we will be getting upside on gold and even greater upside on silver. So many people waiting for that, and we've been discussing it, but as long as it stays in that range, and we did get higher numbers, actually, you're going marginally higher. That's generally not bullish when you go marginally higher across the board here. We had wicks that probed. So broadly, this only ends in a downside break on balance of probabilities most occasions. But it's sure gone on for a while. And all I can say is we're turning back down to the lower part of the range. So a small little flicker of light there for the long-suffering stackers. And I would take the opportunity, again, to dollar cost average into both. And possibly with this continuing to come down, maybe silver would be a good point of accumulation as well.
Now, in the meantime, as we've seen a pullback in precious metals here, it seems like we're seeing a pop in cryptocurrencies, especially Bitcoin. Your take on that, because I know a lot of people who are looking at the precious metal markets also pay attention to the cryptocurrency markets as kind of an alternative currency. So if you wanted to share maybe the Bitcoin chart and what is going on there.
Yes. There's actually a very big Bitcoin move. So we got kind of excited about our 47.5 break. I've got a chart that I prepared for you here. This is Bitcoin, and we're seeing this is a 150. It's a 150 move, $150,000, by the way. So that's quite a big shout as part of it. And you might say, well, where are you getting that from? So there was the 64,000. This was a 64K. high, and then you made a marginally higher one, which was negative of 69K over here. Most people don't know, but there were head and shoulders in both instances here, and they were fascinating, absolutely fascinating. You ended last bull run with two head and shoulders. The first one took you down into the 30K level. This was this one over here. And it had a 47.5 neckline. And we retain those as very interesting numbers to be considered and held that you will have interaction with again in the future. And you broke down from there. That would have been your triggering, and you got down to here. And many people thought that's the end of the bull. But we actually had one more run in us. And we did the 69K run and then set up an even larger head and shoulders. That one gave us right the way down to the 16K as a bottom. So it called the bottom. That was your book ending, end of bull, beginning of bear. And then you had all the news that went with that. 3 Arrows Capital, FTX, you name it, the whole shooting match. And that ended up with you running 16K. So that was huge. But the neckline of 47.5 on that first head and shoulders, which was the first point of where we were really gasping. Don't forget, you got 64 there, and you traded as low, I think, as 29 here. So that was a 50% plus fall. You know, half is 32. You slipped about 55% there. That was like, whoa, it isn't all bull here. And a lot of people got quite shaken up. So if I just remove that, what does that say about where we are now? Well, we revisited that 47.5 on the way down during the bear market, and we call that a left shoulder over there. It was a bit of a bull flag, if you can see, if you know anything about technical analysis. The typically framing is it's a bear flag. My apologies. I think I said bull flag, a bear flag. In other words, a pattern for downside, a channel. And that broke to the downside. Now, that was a long time ago. That was in the beginning of 2022. That was during the lengthy bear period. It was quite a long bear period till the lows here very late in 22. Since then, we've been working up slowly. So this has been a very moderated recovery bull. We had a blow off that touched 49 here. And then we got this, we're on the left shoulder here. Let's label them. Left shoulder. My S is going to be a little bit interesting. There we go. And then we're on a right shoulder on the orange here as well. So this is an inverted head and shoulder, which is, and this is quite ironic because we're talking about the same pattern. This is why I refer to it as bookending. You had this big pattern here that broke down, that gave you the lows. and now you've got an even larger one where the head is right at those lows. So it's this big basement. That's a little bit complex. Many people say that's not a typical traditional one. We're comfortable with it. We talk about complex head and shoulders in our own theory, but the target generated up there is 148,000, and this is a break. So I am expecting, unfortunately, for the gold bugs, Bitcoin to be outperforming during this period. However, if we are to receive a sudden demand-destroying event, much like we got in March 2020, remember that 4-year cycle of quantitative easing, quantitative tightening, the Bitcoin halvening cycle, and also the election cycle. They're all very well coordinated. So I'll just bring that main chart of Bitcoin back up in the live sense so that everybody can see that. If you were to get a flush out on a event-driven problems, that could be very, very interesting. And the gold tends to hold up better than Bitcoin when there's flush outs to the downside. So I'll just highlight that on a clean chart. That is our March 2020 flush out for Bitcoin. It was already starting a move up. So you've got a warning to people that trade over leveraged. Because for the quantitative easing to properly come in on a scale, there is event needed, an event-driven risk, such as March 2020, and that means you get a washout to the downside. That means all the retail guys get crushed, and all the commercial guys make the money, and they even take your Bitcoin off you. So that was devastating. If you were leveraged long here during this period up, the event would have washed you out. And I will highlight that for gold on the same time frame. We're on a weekly chart there. If I put gold on the weekly, that overall move was not nearly as destructive. You can see it here in the same place as those residue lines. There it was, the sell-off, and you were straight back up. You fell from around 1680 for a very short period to by about $200 at about 1460, and then bang, you were up and into the new highs on the easing. So if we are to go through something similar, an event, demand-destroying event, a flush out, just a little bit of warning on that optimism to 150K. We can be correct, but you could go up to 60, 70,000 and come back down to the 47.5 quite easily. We could go to 80,000 and come down to the 47.5 if that is a dramatic enough event of demand destruction. While gold, you might lose $200 on your gold, and if you sit it out for a number of weeks, you're back up. So there's upside to volatility and higher beta instruments, and there's downside. So depending on whether you're leveraged or you're holding tight and it's money you're happy to lose, just bear that in mind when you're comparing that crazy number of 150,000 for Bitcoin, and you say, why am I holding on to metals in this environment? When you get tested, you'll remember why. So there's room for both horses in your stable, a racehorse and a proper, strong Derbyshire plow-pulling horse that never goes too fast, but is a cold blood and goes every time he's needed to go and never pulls up lame on you. So just something to remember in that as well.
Now, what sort of demand-destroying event do you see could happen in the near future? Is there anything specifically you're looking at?
I'm definitely the wrong person to ask. I'll sit there guessing and listening to people in the World Economic Forum that have thrown all forms of possible threats out to us on the basis that they're so smart and Nostradamus-like. But I think there's been an escalation. So the great irony recently is we've had the US talk about insufficient enlisted troops, the British, various European nations, right down to Australia, that are completely unthreatened by Russia, in my understanding of geography, all saying we have insufficient troops for the threat from Russia. So I'm quite bemused by that. So on the one hand, you're getting this double speak, this dichotomy. On the one hand, yes, we want to win the war against inflation, the poor consumer. No, they don't. Central banks, inflation is policy. They have way too much debt. They want to devalue that debt by destroying money. But they're going to talk about how they want to, cure it because that's their official remit. But the unofficial remit, they're talking about war. They're keeping a bid under oil by talking about war. You have synchronized media from Australia to Canada to Europe to Britain to America, all about escalation. There's 90 billion now being sent for Israel and Ukraine to drag these things on. These are things that are keeping inflation up. If there's one thing you don't want to keep up for inflation numbers, it's oil. remember Biden was releasing the US reserves to show how he was winning the war on oil, to cause a temporary glut and keep a suppression on the price. So now you see this. So everybody understands oil is one of the biggest variables that goes into everything: packages and delivery, travel, business, all forms of things. So there's a lot of double speak in there. They've spoken about Russian hacks. They've spoken about Chinese, probably another pandemic. We've got all these pandemic preparedness things. Who knows, Elijah? I really could not guess any better than yourself. But there will be something, and we've got most of the likelihoods. I'm not too big on the alien invasion theory, but who knows? That might come later. So, we're watching for that narrative, and your guess is going to be as good as mine. That's outside of my core expertise for sure.
Now, if we're looking more towards the long term, obviously you are still bullish on gold. It's the short term. It seems like we could see quite a bit more of a sell-off here. What kind of time frame are you looking for between that short-term bearish outlook and the long-term bullish outlook?
It's a good question. So it's quite interesting that in halvening events, there's been a couple of periods where gold's gone down and Bitcoin's gone up. But I actually have them generally in the category of anti-fiat, and more often than not, there's actually the same correlation. In other words, good for gold, good for Bitcoin, because they're anti-dollars in essence. But there are periods, particularly around this halvening period, where you can get a bit of divergence. So I'm actually pretty bullish. And remember, there's also time frames in this. So short term, I think gold can get dipped a little bit more. But on the macro, I'm bullish both. So there is the correlation on the macro level, and short and medium and long term, I'm bullish Bitcoin, while short term, I'm concerned for gold, medium and macro, I'm bullish. So we are currently in one of those slightly rare phases where there's a divergence in my anti-fiat category. And that makes me think it won't be too long and too bad for gold to the downside. But we can get a little bit of a pushback on that. So don't forget, people will, if there's fear, or if there's the less likelihood that rates are going to go down, people will buy bonds on the basis that they're going to hold value. They don't want to buy them if rates. They don't want to buy them if rates are going to spike, but they're more comfortable with holding them if there's less volatility in the rates environment. So that can take a little bit away from the gold anti-fiat market. I think the industrial element is keeping silver up a little bit. I don't know what, there's better people again for supplies above ground, but I do think we've been running those a bit thin. Solar panels are becoming, ubiquitous in most nations where there's strong sunshine. So I think silver, I don't see too much more downside, and I see just a little bit more at the fringes for gold. But macro, both crypto in a bull market and gold to revert to being your good hold. And it's actually an opportunity to just rebalance your gold versus silver holdings. If it dips, you might want to actually buy the gold if you've already got a lot of silver, just to have a little bit of both. So they both serve you. I'm not sure I fully answered your question in all of that, but I don't expect it to be too intense. Unless, wild card, just park a little, it feels like I'm putting my foot in the door on something, unless we roll into something very severe, which will have news and everything about it, and the crisis will have a name, and you'll know it when it happens. Like your previous question, I can't tell you what name it will be given, but there is something that's going to have to run geopolitically. At the same time, financial shenanigans that are collapsing need dealing with. The media has been weaponized. The narrative and the framing for what's supposedly good for gold with the interest rates go up. We are deep into capital preservation. And the digital option is the one they're wanting to push you on, which is also why Bitcoin is doing well when they least want gold to do well. Because we're really in a debt. The supply of new treasuries is going to come so thick and fast. They're way overspending, even just maintaining existing programs. Then they've got 90 billion here for a war in another part of the world and supporting Israel, et cetera, et cetera. People must understand that's borrowed into existence money. And your tax receipts for your corporations and personal tax takes are not covering half what you need in there, and the rest is new issuance. new issuance of debt. And the Fed will have to eventually monetize this because international demand has dropped greatly as a result of this bifurcation too. So this is what we should be talking about, and that's a capital preservation issue and not going digital. I don't want to be all in on Bitcoin. I want to make money, yes, but I don't want to be all digital because something you hold in your hand is something they have to send a man with a gun to take off you. Digital open source banking, which is the way I view blockchain at the moment. And the other interesting thing, and this is a bit long form, and I'm sorry to be extending this a little bit in my answer, but it's really interesting. I don't know if you've noticed, Elijah, privacy tokens are absolutely getting crushed and aren't being discussed about. There's no ETF discussion for Monero or Zcash or anything like that. This is about global tokenization and surveillance finance, and privacy is verboten. And remember how they used to introduce Bitcoin. It was this thing for drug dealers and people who wanted to buy dark firearms on Pirate Bay and all of this, and hiding from paying their taxes and their fair dues. It never was. It never had that capability. It's very searchable. It's open source banking that is less private than your current online banking. And you were sold a pup there. And all the privacy tokens are largely being squeezed out of brokerages. So if you have a liquidity provider, for example, Simple FX, they won't they won't allow trade in the privacy tokens anymore. So this is the silent issue that's being moved. And these are the points that Snowden and Julian Assange, who are probably heroes in my book, and that continue to suffer on and weren't given a pardon by Donald Trump when other people that were guilty of fraud and a batch of others in these dying days were not pardoned and are still behind bars. And that should tell you everything you need to know about how the world is set up going into this election year. And I would take it seriously, and I would make sure you have physical precious metals. And even if you dollar cost average, that's great.
And it is important, as you mentioned, to keep in tune with the independent media, because the mainstream media can really be quite biased often. So if our viewers are interested in learning more about your channel and your website, where can they find you?
The Market Sniper, we specialize in preservation of wealth, building wealth and preservation of wealth in reset times. And this is the times of that, without shadow of a doubt. And you're doing God's work by giving me airspace and airtime, Elijah, and I thank you truly for that. And I wish all patriots and sound money advocates the absolute best. And see you next time.
Fantastic. Francis, once again, thank you so much for your time, and God bless.
Same to you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 12th through February 19th, 2024, while supplies last. First, we feature backdated 1-ounce Silver Philharmonics at $3.15 over spot with a minimum order of 50. We also have pre-1933 gold $10 and $20 Liberties at $99 over melt and $145 over melt, respectively. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.